If you're hoping to buy a home this year, you're probably paying close attention to mortgage rates, since mortgage rates can impact what you can afford when you take out a home loan. And affordability is a big challenge right now. It's a good time to take a look at the big picture of where mortgage rates have been historically versus where they are today. Beyond that, it's important to understand their relationship with inflation for insights into where mortgage rates may go in the future. Let's get a little context in regards to the sticker shock we're seeing currently. Freddie Mac has been tracking the 30-year fixed mortgage rate since April of 1971. Every week, they release the results of their primary mortgage market survey, which averages mortgage application data from lenders around the country. Looking at the right side of the graph, mortgage rates have increased significantly since the start of last year. But even with that rise, today's rates are below the 52-year average. While that historical perspective is good context, buyers have gotten used to mortgage rates between 3 and 5%, which is where they've been over the past 15 years. That's important because it explains why the recent jump in rates has you feeling sticker shock, even though the rates are near their historical average. While many buyers seem to have adjusted to the elevated rates over the past year, a slightly lower rate would certainly be welcome right now. To determine if that's a realistic possibility, it's important to look at inflation right now to see where rates may go in the future. The Federal Reserve has been working really hard to lower inflation since early 2022. That's significant because historically, there's been a correlation or connection between inflation and mortgage rates. This graph shows a pretty reliable relationship between inflation and mortgage rates. Looking at the left side of the graph, each time inflation, shown in blue, moves significantly, mortgage rates, shown in green, follow suit shortly thereafter. The circle portion at the far right of the graph points out the most recent spike in inflation, with mortgage rates following closely behind. As inflation has fallen a little bit this year, mortgage rates haven't yet made a similar move. This means, if history is to be our guide, that the market is waiting for mortgage rates to follow inflation and head back down. It's impossible to predict what mortgage rates will do for sure, but moderating or lower inflation means mortgage rates heading back down in the near future would fit a well-established trend. Let's recap. To understand where mortgage rates may be going, it makes sense to take a look at where they've been in the past. There's a clear connection between inflation and mortgage rates. And if that historical relationship holds true, the recent decline in inflation means there may be good news in regards to the future of mortgage rates and your home ownership goals. If you have any questions about anything we've talked about today, or would like some data on an area outside of Long Beach, please reach out to me. I'm Brandon Pettis. See you next month.